You know, if you spend any time on investing forums, you've seen the debate 1,000 times, SPY or VOO. Which S&P 500 ETF is the one to buy? It's probably one of the most common questions out there for new investors. So in this explainer, we're not just going to give you the answer, we're going to show you why that question itself might be distracting you from what really matters. Let's dive in.
All right, first up, the main event. We're talking about the two heavyweights of the S&P 500 index fund world. In one corner, you've got SPY, the OG, the original, and in the other corner, VOO, the super popular contender from Vanguard. Now, both of these are designed to do the exact same thing, track the performance of the 500 biggest companies in the US.
So where's the real difference? Well, it all comes down to the fees, the expense ratios. SPY charges 0.0954%, while VOO comes in at just a tiny 0.03%. That might not sound like a lot, but do the math. VOO is more than 3 times cheaper. On top of that, VOO's structure as an open-ended fund is generally a bit more tax efficient for those of us who are in it for the long haul. And we're about to see just how much that matters. Okay, so you might be thinking a fraction of a percent, who cares? Well, let me tell you, it adds up in a huge way over time. This is kind of like compounding, but it's working against you. Just look at this. On a $10,000 investment, you'd save over $800 in fees with VO after 30 years. Now imagine that with a much larger portfolio. You can see how this becomes a really big deal. The longer you invest, the more those little fees can eat away at your money.
So there you have it, right? Case closed. For any long-term buy-and-hold investor, VOO is the pretty obvious winner. It's cheaper, it's more tax efficient, it's a slam dunk. But what if I told you that's not the end of the story? What if this whole debate is actually a distraction from an even more important decision you could be making? All right, so this is where things get really interesting. We've pretty much settled the SPY versus VOO thing, but what if there's a better question we should have been asking all along? Let's get into that right now.
Check this out. This is a quote from Dr. Jim Dahl. He founded the White Coat Investor, and he's a really respected voice in the finance world. And he says he doesn't use S&P 500 funds at all. Wait, what? That just begs the question, right? If VOO is clearly better than SPY, what could possibly be better than VOO? Well, the answer is all about thinking bigger, way bigger. Instead of just owning the 500 largest companies, what if you could own the entire US stock market? I mean, all of it. The giants, the mid-sized companies, and even the small up-and-coming players.
And that brings us to something called a total stock market index fund, or TSM for short. The idea is super simple, really. Instead of just owning the top 500 companies, you own a tiny slice of every single publicly traded company in the US. Talk about diversification.
So think about it like this. When you buy an S&P 500 fund like VOO, you're buying 100% large cap stocks. You're betting on the biggest of the big, the household names. And hey, that's not a bad bet, but it does mean you're completely missing out on another huge part of the market. Now compare that to a total stock market fund like VTI. See the difference? Yeah, it's still mostly the big guys, but you also get exposure to thousands of mid-size and small-cap companies. You go from owning about 500 stocks to over 3,500. It's really the difference between owning the biggest needles and owning the entire haystack. So why is this so important to think about right now? It all comes down to market cycles. For the last decade or so, large-cap stocks have just been on an unbelievable tear. It's made S&P 500 funds look completely unstoppable. But as we know, history tells us that these trends, well, they don't last forever. Okay, so let's look at the history here. On average, the cycle where small caps underperform the big guys lasts about 9 years. But look where we are right now. We are in year 12 of this trend. Research from the CFA Institute points out that this is a really, really long time, which could mean a shift is on the horizon. And there are a few good reasons to think a change might be coming. First off, these cycles just tend to swing back eventually. Second, the higher interest rate environment we're in has historically been pretty good for high-quality, smaller companies. And third, right now, small caps are actually looking like a better value with stronger quality than a lot of the bigger companies. Now, this isn't about trying to time the market, not at all. It's just about understanding why being diversified into these smaller companies could be really beneficial, especially right now. So let's pull all of this together. We started with SPY versus VOO, then we moved on to the S&P 500 versus the total stock market. We've made a pretty good case for broader diversification, but now let's get back to what really, truly matters for you as an investor. Take a look at this number, 0.99. What does that mean? It's the historical correlation between an S&P 500 fund and a total stock market fund. And in plain English, that means they move in lockstep. Their day-to-day performance is so close you can barely tell them apart. So while diversification is important over the long run, the immediate difference is tiny.
And this really brings us back to Dr. Dahl's whole point. He has this great analogy where he says debating between SPY, VOO, and VTI is like arguing about what brand of tires to put on a car that has no engine. It's a tiny detail that distracts you from the much bigger problems. So at the end of the day, we're going to leave you with this. Are you asking the right question? Because obsessing over which of these almost identical funds to pick will have a tiny, tiny impact on your financial future compared to the things that really move the needle. How much are you actually saving and investing? Is your overall mix of stocks and bonds right for you? And maybe most important of all, do you have the discipline to just stick with your plan year after year through all the ups and downs? Because those are the questions that will actually make you wealthy.